So, welcome to episode 14 of our series Mutual Fund Simplified. And today we'll simplify something that confuses a lot of investors: absolute returns, CAGR, and XIRR. Now, which one should you trust? Okay, so when you check a fund fact sheet, you will see different return numbers. One shows 40%, another shows 12%, and you wonder what's the real return? The answer depends on which return metric you're looking at. Absolute returns is basically the simple growth in value without considering time. Example, let's say if you invest 1 lakh rupees, it grows to 1.4 lakhs. So the absolute return is 40%. But it doesn't mention anything about time. How long did it take to reach this 40% return? Now bring in CAGR, compounded annual growth rate. Very important. The gold standard for long-term returns. Tells you the average annual growth rate considering compounding. Example, 1 lakh became 1.4 lakhs in 3 years. So what is the CAGR? 11.9% annualized return per year. Now that brings us to the question, what is XIRR? You would have heard about XIRR, Extended Internal Rate of Return. Now what is it? So what if you invested through SIPs, not a lump sum? Let's say 10,000 rupees every month, not a single lump sum. That's where XIRR comes in. It calculates your true annualized return by considering the actual dates and amounts of each investment depending on the inflow and outflow of the money. Example, 10,000 rupees per month for 3 years. Final corpus is 4.6 lakhs. What is the XIRR? 14.8%. So what is the key takeaway? Always rely on CAGR for comparing long-term investments. Absolute return is fine for short periods, but it can mislead if the timeline isn't very clear. Think of absolute versus CAGR like car mileage. If I tell you I drove 300 kilometers on one tank, that's like absolute return. But if I tell you my car gives 15 kilometers per liter on average, that's CAGR. CAGR gives you a more realistic picture. So remember, absolute returns may look flashy, but CAGR is what shows you the real power of compounding. In episode 15, we'll dive into rolling returns, the fairest way to judge a fund's consistency. Stay tuned.